When you go into a doctor's office with a broken arm, the whole process is incredibly straightforward. You get an x-ray, the doctor slaps the film up on that glowing light board, points to a jagged white line and says, well, there's your problem.
Right. It's just pure engineering at that point. It's structural.
Exactly. You have a definitive diagnosis, and from there, you get a definitive treatment plan. But the second you step out of a medical clinic and into the world of global finance, trying to figure out how to invest your money or, build wealth, that X-ray machine is entirely useless.
Oh, totally useless. I mean, the human brain craves that level of diagnostic clarity. But you look at the global economy today, and there are no clean white lines. The landscape is just incredibly murky.
Yeah, you've got inflation doing completely unpredictable things, tech stocks acting like they're disconnected from reality, and financial talking heads just screaming contradictory advice on television 24/7. It feels less like a science and more like sheer chaos.
Diagnostic muddy waters. That's really what we're swimming in. And because the picture isn't clear, well, the default human reaction is paralysis.
People just freeze.
Exactly. They look at the stock market, they look at the headlines, and they just freeze. They leave their money in a checking account being eaten alive by inflation because the alternative feels like, gambling in a casino where you don't even know the rules.
And that paralysis is exactly what we are dismantling today. We are answering a very specific question for anyone listening who wants to build actual, sustainable wealth. How do you achieve true financial freedom in an economic environment that feels increasingly insane?
Which is a huge question.
It is. And we aren't going to be talking about clipping coupons or basic budgeting. We are digging into the financial playbooks of the absolute elite people like Ray Dalio, Warren Buffett, Jack Bogle, and David Swensen.
The top 0.001% of investors.
Right. And what's incredible about studying that specific group of titans is that their strategies are completely counterintuitive to what the average American is taught about money. I mean, the middle class is taught to hand their money over to quote-unquote experts, pay invisible fees, and just hope for the best.
But the elite operate on an entirely different set of mathematical and psychological principles. They don't just survive economic turbulence, they actually use it to accelerate their wealth.
And before we get into the exact mechanics of those principles, we need to acknowledge just how bizarre the current economic weather actually is. Because it's not just your imagination, things really are unprecedented out there.
Oh, absolutely. Look at what central banks around the world have been doing over the last few years.
Yeah, we've seen major first world economies like Switzerland, Sweden, and Japan experimenting with negative interest rates. When I first read about that in our source material, it fundamentally broke my brain.
It's hard to wrap your head around at first.
It really is, because the entire premise of a bank is that you give them your capital, they lend it out to buy houses or build businesses, and they pay you a yield for the privilege of using your money.
That is the literal foundation of modern capitalism. But a negative interest rate flips the entire model upside down. It means depositors are effectively penalized for saving.
You are paying the bank a fee just to hold your money.
Exactly. Central banks do this when they are desperate to force money out of bank vaults and into the economy to stimulate growth. They are basically telling banks and large institutions, if you park your cash here, we will shrink it.
Which is terrifying for anyone just trying to save for the future. And it's not like this is a normal cyclical trend. Economic historians were asked to look back and find the last time the global economy experienced a period of negative yields like this.
And how far back did they have to go?
They had to go back 5,000 years. Throughout all of recorded banking history, this is completely uncharted territory.
When you have policies that haven't been seen since the dawn of civilization, you are naturally going to see some anxiety at the highest levels.
Definitely.
There's a story about Alan Greenspan, the former Federal Reserve chairman. This is a man who steered the U.S. economy for 19 years, through 4 different presidencies, through the dot-com bubble, through market crashes.
A guy who has seen it all.
Right. And he was asked recently, given all this volatility and these experimental central banking policies, what he would do if he were still running the Fed today. His answer was one word.
Resign.
Wow. Okay, let's unpack this. When the ultimate financial insider throws his hands up and says he'd quit, how is the average person supposed to navigate this?
It feels hopeless, right?
Totally. If a guy with decades of macroeconomic data at his fingertips has no idea what's going to happen next, I have zero chance of predicting the market.
What's fascinating here is that realization that you cannot predict the market is actually the most liberating concept in finance.
Wait, really? How so? Because the greatest investors in the world do not have crystal balls. Warren Buffett doesn't know what the S&P 500 is going to do next Tuesday. Ray Dalio doesn't know exactly when the next recession will hit.
They just accept the uncertainty.
Exactly. They acknowledge that the global economy is a complex, chaotic system with too many variables to forecast accurately. So instead of wasting energy trying to predict the future, they focus strictly on what they can control.
It's a massive paradigm shift because, I mean, the financial media ecosystem is entirely built on predictions. Every article is about where the market is going, what the Fed will do next month, which stock is going to pop.
But the billionaires are ignoring all of that. They are just building a system that works regardless of whether the economic weather is sunny or pouring rain.
Since we can't predict the global economy, we have to rely on the fundamental mathematical laws of wealth building that always work.
Right. And a big part of that requires tapping into something very primitive, human pattern recognition.
Like our hunter-gatherer ancestors.
Exactly. For thousands of years, humans were entirely reactive. We were at the mercy of the elements. But eventually, our brains developed the capacity to recognize seasonal patterns. We realized that after the cold comes the thaw.
We learned when to plant seeds and when to harvest.
Yes, and that single cognitive leap allowed us to transition from a life of constant scarcity to a life of agricultural abundance. We stopped just reacting to the weather and started using the seasons to our advantage.
And that same evolution has to happen in how we view the financial markets. The economy has seasons, too. We know for an absolute fact that a market winter, a correction, or a major crash is coming.
History guarantees it. We just don't know the exact date it will arrive.
Right, but a farmer doesn't panic when winter arrives because they prepared for it. They don't try to plant corn in January.
In the financial world, once you accept that winter is a guaranteed part of the cycle, you stop living in fear of it.
I hear this all the time, though, and doesn't this just make people want to hoard cash under their mattress? I mean, why get in the game if winter is guaranteed? People who got burned in 2008 often say, you know, the casino is rigged, the floor will fall out eventually, so I'm just keeping my money in cash.
It feels safe, but keeping your money in cash is actually the only guaranteed way to lose wealth.
Because of inflation.
Exactly. Inflation is a silent compounding tax. If inflation averages just 3% a year, the purchasing power of your cash is cut in half every 24 years. You are mathematically guaranteeing that you will be poorer in the future.
That's a scary thought.
But, more importantly, by sitting on the sidelines, you completely miss out on the most powerful force in finance: compound interest. Warren Buffett has repeatedly said that his massive fortune is the result of three things: living in America, lucky genes that allow him to live a long time, and compound interest.
Let's break down the mechanics of compounding, because it's one of those phrases people hear so often that it loses its impact. People think of it as just like earning a little extra on your savings.
It is so much more violent than that. There is a classic case study that perfectly illustrates the math, involving two hypothetical friends, Joe and Bob.
The math on this is staggering when you look at the actual numbers year by year. Okay,
Yeah.
so Joe gets an early start. At age 19, he decides to start investing $300 a month.
Which is a solid habit for a 19-year-old.
Definitely.
Yeah.
He puts that money into the market, and he does this for just 8 years. When he hits age 27, he completely stops. He never adds another dime of his own money to that account.
So he just lets it ride.
Exactly. So over those 8 years, his total out-of-pocket investment is $28,800. Let's assume a 10% annual return, which tracks with the historical average of the U.S. stock market over the last century.
A very standard benchmark.
Yeah. Joe just lets that money sit there until he retires at age 65. That initial $28,800 grows into $1,863,287.
It's amazing. Nearly $2 million generated from less than $30,000 in original capital.
Now we look at his friend Bob. Bob decides to enjoy his 20s and doesn't start investing until he turns 27, the exact same age Joe stopped.
Classic Bob.
Right. So Bob also invests $300 a month, but because he started late, he keeps investing that $300 every single month, year after year, until he is 65.
That is 39 years of consistent saving.
Yep. Bob's total out-of-pocket investment is $140,000. Assuming that same 10% return, Bob retires with $1,589,733.
So Joe ends up wealthier by over $270,000, despite putting in $111,000 less out of his own pocket.
He put in a fifth of the effort and won by a landslide. When you look at those numbers, I mean, it defies common sense. Bob was so much more disciplined for so much longer. How does the system reward the guy who quit in his 20s?
Because the active ingredient in compounding isn't the capital, it's the time. Compounding is exponential growth. It's growth upon growth.
Break that down a bit more for us.
Sure. Think about what happens inside Joe's account. In the first year, he earns 10% on his money. But in the second year, he earns 10% on his original money, plus 10% on the gains from the first year. The money he made starts making its own money.
Right, the snowball effect.
Exactly. If you own shares in a company like Apple or Microsoft, those businesses are constantly generating profits. They reinvest those profits to create new products, which generates more profit, which drives the stock price higher. By starting at 19, Joe gave that snowball a massive hill to roll down.
By the time Joe hits his 50s, that snowball is moving at incredible speed. His account is growing by tens of thousands of dollars a year, and he isn't lifting a finger.
By age 60, his portfolio is generating over $100,000 a year in sheer growth without him adding a dime. Time is doing all the heavy lifting.
Bob's total return on his invested money was about 1,000%. Joe's return was over 6,300%.
The practical reality for anyone listening is that you have to shift your identity. The vast majority of Americans are purely consumers.
We buy the iPhone, we buy the Amazon Prime subscription, we buy the Netflix account.
Right. You are spending your money to fund the revenue of these massive corporations.
Right.
To build wealth, you have to cross over and become an owner.
Oh.
You have to capture a piece of the economic engine that is driving those profits.
And the only way to reliably do that without relying on superhuman discipline is automation.
You can't just wait to see what's left over at the end of the month.
Because there is never anything left over. You have to set up a system where a percentage of your income is instantly routed into an investment account before it ever hits your checking account. You build a freedom fund.
If you are currently automating 10% of your income, find a way to bump it to 15%.
Yeah, if you're at 15%, push it to 20%. The slight friction you feel in your lifestyle today is microscopic compared to the millions of dollars you are generating on the back end through compounding.
But generating that wealth is only the first half of the equation. Getting the money is one thing, keeping it is entirely different.
Because once you start building this nest egg, you become a target. There's an entire industry fundamentally designed to siphon that wealth away from you, slowly and invisibly.
The silent killers of wealth. We are talking about Wall Street fees.
And the way they get you is by creating an illusion of choice and complexity. There are over 9,500 mutual funds in America right now. There are literally more mutual funds than there are individual stocks traded on the U.S. exchanges.
It's absurd. It's like walking into a grocery store to buy cereal and being confronted with 50,000 different options.
The sheer volume is designed to overwhelm you so that you give up and just pay an expert to handle it for you.
And handing your money over to an actively managed mutual fund is where the bleeding starts. Jack Bogle, who founded Vanguard and basically invented the index fund, did the math on this, and it is devastating.
Walk us through Jack's math.
Let's say the broader stock market returns 7% annually over a 50-year investing lifetime. Because of the compounding we just talked about, every $1 you invest in the market turns into $30.
Turning $1 into 30 is a phenomenal deal.
It is. But the average actively managed mutual fund charges you a fee, often around 2% per year, to manage your money. They take that 2% off the top, regardless of whether the fund goes up or down.
So your 7% return drops to 5%.
Exactly. And over that same 50-year period, compounding at 5% instead of 7%, your $1 only grows to $10.
Wait, that is a staggering difference. Without the fee, I end up with $30. With the 2% fee, I end up with $10.
Yes. You provided 100% of the capital. You took 100% of the market risk. If the market crashes, you bear the brunt of it. But because of a seemingly tiny 2% fee, you give away 67%, two-thirds of your potential wealth, to a money manager.
Well, wait, aren't you paying that 2% for a reason? The entire pitch of the financial services industry is that these active managers are like Ivy League educated quants sitting in glass towers with supercomputers. They have access to data I don't have. Shouldn't I happily pay a 2% fee because they are going to use their expertise to bet the market?
It's a beautifully crafted marketing narrative, but the empirical data proves it as a complete myth. When you actually look at the numbers, 96% of actively managed mutual funds failed to beat the market over a 15-year period.
96%. That's not a margin of error. That is systemic failure.
It is. Yeah. And it's not because these managers aren't smart. It's because the mechanics of active management create an insurmountable hurdle.
Because of all the trading.
Exactly. When a manager is constantly buying and selling stocks trying to time the market, they're racking up massive internal trading costs. Plus, the market itself is hyper-efficient. Millions of incredibly smart people are looking at the exact same information at the exact same time.
It is a zero-sum game.
Right. For an active manager to beat the market by 2%, they have to find someone on the other side of the trade willing to lose 2%. When you combine the difficulty of consistently outsmarting the collective wisdom of the market with the heavy fees they charge, the math simply doesn't work. You are systematically overpaying for underperformance.
To put a visual to it, our source text uses a great analogy. It's like walking onto a car lot, paying the sticker price for a brand new Ferrari, and the salesman hands you the keys to a rusted, mud-splattered tractor.
You would call the police if that happened in real life.
You would. But millions of Americans accept that exact transaction inside their retirement accounts every single day without realizing it.
And what's worse is that the 2% fee is usually just the tip of the iceberg. That 2% is the expense ratio, which is the legally required advertised fee. But Forbes magazine did an extensive analysis on the hidden costs of mutual funds, and it gets so much darker.
Oh boy. Unpack that for us.
On top of that expense ratio, you have transaction costs.
Yeah.
When the manager buys and sells stocks inside the fund, there are broker commissions and bid-ask spreads. That eats up about 1.44% on average.
So we are already at 3.44%.
Then you have something called cash drag.
Yeah.
Mutual funds have to keep a certain percentage of their assets, usually around 5% in cash, so that they can pay out investors who decide to sell their shares on any given day.
But because that 5% is sitting in cash, it isn't invested in the market.
Right. In a bull market, that drags down your overall return by about 0.83%. And if this money isn't in a tax-sheltered retirement account, the constant buying and selling triggers capital gains taxes, which cost you roughly another 1%.
When you stack the expense ratio, the transaction costs, the cash drag, and the taxes, what is the actual total cost to the investor?
It can be a staggering 3.17% to 4.17% every single year.
That is basically criminal. Think about it in everyday terms. Imagine you and a friend walk into a coffee shop. Your friend orders a standard black coffee and pays $4.15. That is the index fund. It's simple, it's cheap, it gets the job done.
A solid cup of coffee.
Yeah, but you ordered the exact same black coffee, but you order it through the complex structure of an actively managed fund, and the barista charges you $249. You are paying 60 times more for the exact same product.
This is exactly why Warren Buffett issued his famous $1 Million Challenge back in 2008. He bet Protege Partners, a highly respected wealth management firm, that a plain, vanilla, low-cost S&P 500 index fund would outperform a hand-picked basket of elite hedge funds over a 10-year period.
And hedge funds are the ultimate expression of active management, right?
Oh, absolutely. They usually charge a 2% management fee plus 20% of any profits they generate. The justification is that these guys are financial wizards who can navigate any market environment.
And the result of that bet, Buffett absolutely crushed them. Over a decade that included the massive recovery from the 2008 financial crisis, the simple index fund generated a return of 8.5% annualized.
And the hedge funds.
The high-priced hedge funds averaged just under 3%. The fees completely devoured whatever brilliant stock-picking abilities those managers might have had.
Which leads to a very disturbing question. If the academic research, the historical data, and the greatest investors in the world all agree that high-fee active funds are toxic to wealth, why are they the default option in almost every corporate 401k plan in America?
This is where we get into the 401k pay-to-play scheme, which is honestly one of the most frustrating mechanisms in modern finance. John Oliver did a brilliant deep dive on this a few years ago. He compared fees in your retirement account to termites.
That's a perfect analogy.
It is. They are microscopic, you don't notice them day to day, but over 30 years, they hollow out the entire structural foundation of your retirement.
To understand how this happens, you have to look at the mechanics of how a 401k plan is built. When a company wants to offer a retirement plan to its employees, they hire a third-party provider or a record keeper to administer it.
And that provider selects a menu of mutual funds that the employees can choose from. You would assume the provider looks for the absolute best, lowest-cost funds for the employees, right?
Because they have a moral, if not legal, obligation to help the employee.
Exactly.
But that's not how the industry operates. In many cases, mutual fund companies actually pay the 401k provider a kickback, often disguised under the term revenue sharing or 12b1 fees, in exchange for being placed on that menu.
If a mutual fund company wants access to the millions of dollars coming out of employee paychecks every 2 weeks, they have to pay a toll to the plan provider.
It is literal pay-to-play. And because low-cost index funds, like Vanguard or Fidelity's zero-fee funds, operate on razor-thin margins, they refuse to pay these kickbacks.
So the 401k provider simply leaves them off the menu. The employee logs into their portal, looks at their options, and all they see are actively managed funds charging 1%, 1.5%, or 2%. They are trapped in a closed ecosystem of high fees.
There's even a documented case of a major insurance company administering a 401k plan, where if an employee absolutely insisted on buying a Vanguard index fund, the provider slapped a 3% front-end load on it.
What does that mean, a front-end load?
A front-end load is basically a cover charge just to buy the asset. So they were marking up a product designed to be cheap by thousands of percent just to protect their profit margins.
That is just wild. For the listener, this means you cannot assume your HR department or your 401k provider is looking out for your best interests. You have to pull the prospectus of the funds in your plan and look at the expense ratios.
If you are stuck in a plan filled with high fees, you need to advocate for change. There are newer companies out there like America's Best 401k, which is highlighted in our source material, that specifically reject the pay-to-play model.
They build plans using transparent, low-cost index funds without the hidden revenue sharing. Moving a mid-sized company's plan from a high-fee structure to a low-cost structure can literally keep millions of dollars in the pockets of the employees over their working lives.
It is the difference between retiring at 60 with dignity and working until you are 75 just to keep the lights on.
All right, so let's assume our listener has executed perfectly so far. They've automated their savings to harness compounding. They've audited their portfolio, stripped out the active managers, and moved their money into low-cost index funds. They have built a highly efficient wealth-generating machine.
A very solid foundation.
But now we have to face the monster in the room. How do you protect this machine from the inevitable market crashes we talked about earlier? How do you slay the bear market?
Well, the physical mechanics of a crash are actually less destructive than the psychological panic it induces. You don't just have to survive the market going down, you have to survive your own brain's desire to hit the eject button.
And it's easy to say don't panic when the market is up, but let's set the reality of what a crash feels like. When people hear the phrase market crash, their minds immediately go to the fall of 2008.
That wasn't just a dip on a chart. That was systemic terror.
Trillions of dollars of wealth vaporized in weeks. Century-old investment banks like Lehman Brothers were collapsing overnight. The credit markets froze. People were losing their homes, their pensions, their jobs.
You turned on the news, and very serious people in suits were quietly discussing whether the global ATM network would even function the next day. It was pure, unadulterated fear.
It felt like the end of the financial world. And if you are reacting emotionally to that environment, you will make catastrophic decisions. The elite investors inoculate themselves against that terror using historical data.
They rely on what the playbook calls the freedom facts. These are statistical realities that provide context, so when the market bleeds, you know it's just a normal bodily function of the economy, not a fatal wound.
Let's walk through these facts because they are incredibly grounding. Fact number 1. Market corrections happen, on average, once a year.
And a correction is defined as a drop of 10% or more from a recent high.
Once a year. We treat a 10% drop like the sky is falling, but historically, it is as common as celebrating your birthday. It is just the market exhaling.
Fact number 2. Bear markets, which are severe, sustained drops of 20% or more, happen roughly every 3 to 5 years. Again, this is a feature of the capitalist system, not a bug.
Economies overheat, debt bubbles form, and a bear market is the forest fire that clears out the dead wood so new growth can occur.
And then there is fact number 3, which is the anchor you have to tie yourself to during the storm. The market always rises eventually.
Throughout the 20th and 21st centuries, we have had world wars, the Great Depression, the oil shocks of the 70s, the dot-com bust, the 2008 financial crisis, and global pandemics. And yet, the long-term trajectory of the broader American market has always been up and to the right.
Human innovation and the drive for corporate profit always win out over a long enough timeline.
Here's where it gets really interesting understanding those facts is how you operationalize Warren Buffett's most famous piece of advice. Be fearful when others are greedy, and greedy when others are fearful.
When a bear market hits, amateur investors see a catastrophic loss of wealth. Elite investors see the greatest buying opportunity of the decade. The businesses they want to own, the Apples, the Amazons, the blue-chip dividend payers, are suddenly marked down by 30% or 40%.
It's the ultimate reframe. A bear market is just the stock market going on sale. Think about it. If you go to your favorite clothing store and see a sign that says everything 40% off, you don't run out of the store screaming in panic.
No, you grab a cart and buy as much as you can.
Exactly. But in the stock market, people see the 40% discount and they run for their lives. And this irrational behavior is perfectly captured in the Dalbar study, which is simultaneously the most fascinating and depressing piece of research in behavioral finance.
It is a sobering look at human psychology. Dalbar is a leading financial research firm, and they conducted a massive study looking at investor behavior over a 30-year period, from 1985 to 2015.
Over those 3 decades, the S&P 500 generated an average annualized return of 10.28%. That is a phenomenal wealth-building engine.
If you had taken $50,000 on day one, bought an S&P 500 index fund, and literally went into a coma for 30 years, you would have woken up with over $941,000.
Nearly $1 million just for staying out of your own way.
Exactly. But Dalbar looked at the actual brokerage accounts of average investors to see what they really made. And the average investor didn't make 10.28%. They made a pathetic 3.66% a year.
Wow.
That same $50,000 only grew to about $146,000. They left $800,000 of potential wealth on the table.
How is that even mathematically possible? How do you underperform the index by nearly 7% a year for 3 decades?
A portion of that underperformance is the high fees we discussed earlier. But the vast majority of it is caused by the behavioral gap.
Yeah.
People simply cannot stomach the emotional pain of volatility.
Walk us through that cycle. What does the average investor do?
Here is the mechanical cycle. The market starts crashing. They watch their portfolio drop 10%, 15%, 20%. The media is screaming that a depression is coming. The pain becomes biologically intolerable.
So, to stop the bleeding, they hit the sell button.
Exactly. They liquidate their stocks into cash at the exact bottom of the market. Then they sit in cash, waiting for things to feel safe again. But the market doesn't send a memo when it's about to recover.
It usually rebounds violently when the news is still terrible.
Right. By the time the economy feels safe again and the investor buys back in, the market has already surged to new highs. They systematically buy high and sell low over and over again for 30 years.
They realize their paper losses and miss the compound growth of the recovery. It's financial suicide. So the million-dollar question is, how do we build a system that prevents us from doing that? Because logic goes out the window when you are watching your life savings evaporate.
The source text spends a lot of time on Peter Mallouk, who is widely considered one of the top financial advisors in the country. He navigated the 2008 crisis incredibly well for his clients, and he didn't do it by just telling them to calm down.
He had a mechanical defense system in place.
You cannot fight raw panic with logic. You have to build the bunker before the storm hits. Mallouk uses an approach he calls core and explore, but the real bedrock of his defense against panic selling is a concept called the Rule of 7.
Let's get into the mechanics of this Rule of 7, because it is brilliant in its simplicity. This is specifically designed for people who are in retirement or approaching it, and who are terrified that a market crash will wipe out the money they need to live on.
The Rule of 7 dictates that you must keep a cushion of up to 7 years' worth of your required income in conservative, yield-producing investments. We are not talking about volatile tech stocks here.
We are talking about high-quality government and corporate bonds, dividend-paying blue-chip stocks, and master limited partnerships, or MLPs.
Let's define an MLP real quick for the listener, because it sounds like Wall Street jargon.
Good idea. Master limited partnerships are often found in the energy sector. Think of the companies that own the massive pipelines transporting oil and natural gas across the country. They're essentially toll roads.
They don't care about the day-to-day price of oil. They just collect a fee for every barrel that moves through the pipe. Because of their specific tax structure, they are required to pay out almost all of their cash flow to investors in the form of high yields.
They are cash-generating engines. So let's look at how the Rule of 7 functions in a real-world scenario. Let's say you are retired and you have a $1 million portfolio. You determine that you need to pull $40,000 a year from that portfolio to live comfortably.
Under the Rule of 7, you multiply that $40,000 by 7 years. That's $280,000. You take that $280,000 and you allocate it into those conservative yield-producing assets, the bonds, the MLPs.
And the remaining $720,000 stays invested in a diversified stock portfolio to capture long-term growth.
Okay, now let's stress test it. A massive bear market hits. The stock market plunges 40%. The talking heads are panicking. The average retiree is terrified because their stock portfolio just got cut in half, and they are forced to sell those depreciated stocks at the absolute bottom just to buy groceries.
But the retiree using the rule of seven does not panic. Why? Because historically, bear markets resolve themselves and return to previous highs within 3 to 5 years.
Since this retiree has 7 years of income safely walled off in bonds and MLPs, they do not have to sell a single share of stock. They just collect the interest and dividends from their conservative cushion to pay their bills.
They live in their financial bunker, completely unaffected by the chaos outside, while they wait for their stock portfolio to naturally recover.
It completely neutralizes the behavioral gap. It removes the mechanical mechanism that forces people to sell at a loss.
And if you have that cushion, you can go even further. While everyone else is selling at the bottom, you take the excess yield from your bonds and use it to buy more stocks at a 40% discount. You turn the crash into a wealth accelerator.
It transforms a catastrophic event into a massive structural advantage.
All right, so we've minimized our fees and we've built a bunker to survive the bear market. But how do we actually decide what goes into the portfolio in the first place? How did the absolute elite evaluate an investment before they wire the money?
The authors studied billionaires across all spectrums, hedge fund managers, venture capitalists, real estate tycoons, and found that regardless of their specific niche, they all adhere to a strict set of rules. They call it the Core 4 Playbook.
These are the fundamental decision-making filters of the ultra-wealthy. Principle number 1 sounds almost laughably simple on the surface. Don't lose.
Right. When I first read that, I thought, well, obviously, nobody wires money to a broker with the goal of losing it. How is don't lose a profound investment strategy?
It sounds like a platitude, but it actually represents a fundamental rewiring of how you view risk. When an amateur investor looks at a potential investment, say a hot new crypto token or a buzzy tech IPO, they ask one question: how much money can I make?
Their entire cognitive focus is on the upside potential. When a professional elite investor evaluates an asset, they ask a totally different question. How do I ensure I am not wiped out if my thesis is completely wrong? They're obsessed with protecting the downside.
Because the math of losing money is brutally asymmetric. Let's explain that math, because it's vital. If you have $100,000 and your portfolio takes a 50% hit, you are down to $50,000.
And to get back to where you started, you don't need a 50% return. A 50% return on $50,000 only gets you to $75,000.
Right. To get back to your original $100,000, you have to generate a 100% return. You have to double your money just to break even.
Exactly. Losing 50% requires a 100% gain to recover. Losing 90% requires a 900% gain to recover. The elite understand that taking massive, uncalculated risks can dig a hole so deep that compounding can never pull you out of it.
Which flows perfectly into principle 2, asymmetric risk-reward. And this concept shatters one of the biggest myths peddled by the financial industry.
The myth that to get high rewards, you have to take high risks. We've had that drilled into our heads since high school economics. High risk equals high reward. Low risk equals low reward.
But the billionaires profiled in this playbook fundamentally reject that. They think it's a sucker's game. They actively hunt for investments where the risk is tiny, but the potential upside is massive.
They want to risk a dime to make a dollar. A great non-stock market example of this is Richard Branson starting Virgin Atlantic Airlines. Starting a global airline is notoriously one of the most capital-intensive, high-risk ventures on the planet.
Most people would assume Branson had to bet his entire empire to get it off the ground.
But he didn't. He negotiated a deal with Boeing to lease a single airplane for 1 year, and he baked a clause into the contract stating that if the airline failed, he could simply hand the plane back to Boeing without bankrupting his other companies.
His downside risk was strictly capped at 1 year's lease payment. His upside risk was a global aviation empire. That is asymmetric risk.
In the financial markets, you find asymmetric risk when there's blood in the streets. Going back to those MLPs. When the price of oil crashes, like we've seen multiple times over the last decade, the entire energy sector gets heavily sold off by panicked mutual funds.
The price of an MLP pipeline stock might plummet by 50%, but the pipeline is still moving the exact same volume of gas, and it's still collecting the exact same toll fees. The fundamental business hasn't changed, just the market perception.
Elite investors step in and buy those assets for pennies on the dollar. The downside risk is minimal because the asset is already historically cheap, but the upside when the market eventually comes to its senses is a massive capital gain on top of a double-digit dividend yield.
It's about finding mispriced assets. Principle 3 is tax efficiency, and this is a blind spot for almost all retail investors. People obsess over their gross return, but the only thing that actually matters in wealth building is your net return, what you actually get to keep after the government takes its cut.
Taxes are the biggest expense in your life, period. Let's look at the mechanics of short-term versus long-term capital gains.
If you are an active day trader or you invest in an actively managed mutual fund that constantly turns over its portfolio, you are repeatedly triggering short-term capital gains taxes.
In the U.S., short-term capital gains are taxed at your ordinary income rate, which can be nearly 40% at the federal level, plus state taxes. You could generate a brilliant 20% return in the market, but if half of that goes to the IRS, your net return is mediocre.
Conversely, if you utilize a buy and hold strategy with low turnover index funds, you avoid triggering those taxable events. And when you finally do sell after holding an asset for longer than a year, you are taxed at the much lower long-term capital gains rate, which is capped at 20% federally.
The elite structure their investments using retirement accounts, tax loss harvesting, and highly efficient index funds to ensure that the compounding snowball isn't constantly being melted by tax friction.
Which brings us to the final rule of the Core Four. Diversification. Harry Markowitz, the Nobel laureate, famously called diversification the only free lunch in investing.
But most people misunderstand it. They think diversification means owning 3 different tech stocks instead of 1.
The playbook outlines Burton Malkiel's framework for true multi-layered diversification. Break those 4 layers down for us.
Layer 1. You must diversify across asset classes. You cannot have 100% of your net worth in the stock market. You need bonds, real estate, perhaps some alternative investments.
Because if the stock market crashes, you need asset classes that are non-correlated, meaning they don't move in the same direction at the same time. During a severe recession, stocks plummet, but high-quality government bonds often go up as investors flee to safety. That non-correlation stabilizes your portfolio.
Layer 2. You diversify within the asset classes. Don't put all your stock money in Apple and Nvidia. Don't put all your real estate money into a single beachfront condo in Florida that could get wiped out by a hurricane.
You use index funds to own thousands of companies across every sector: healthcare, energy, consumer goods, financials.
Layer 3. Diversify across global markets. This is crucial for American investors, who often suffer from extreme home country bias. The U.S. is an incredible economic engine, but it is not the only engine.
There is massive demographic and technological growth happening in emerging markets and in Europe. By holding international index funds, you ensure that if the U.S. economy experiences a prolonged period of stagnation like Japan did in the 90s, your wealth continues to grow globally.
And finally, layer 4. Diversify across time. This is perhaps the most practical tool for the average investor, and it's called dollar cost averaging.
You do not take a massive lump sum of cash and dump it into the market on a random Tuesday, hoping you picked a good day. You deploy your capital consistently, systematically, every single month, regardless of what the market is doing.
The mechanics of dollar cost averaging mathematically force you to be a smart investor. When the market is hitting all-time highs and stocks are expensive, your $500 monthly contribution buys fewer shares.
But when the market crashes and everyone else is panicking, your $500 automatically buys significantly more shares at a deep discount. Over a 20 or 30-year period, this smooths out the volatility and continually lowers your average cost per share.
The ultimate takeaway here is that you need to treat these 4 principles like a pre-flight checklist. Before a pilot takes off, they don't rely on memory. They go through a mechanical checklist to ensure the plane won't crash.
You should do the same with your money. Before you make any significant investment, ask yourself, does this protect my downside? Is the risk asymmetric? Is it tax efficient? Does it improve my overall diversification?
If it fails any of those tests, you walk away.
So we have the complete mechanical architecture in place. We have compounding, low fees, tax efficiency, diversification, and a plan for market crashes. But there is one final obstacle, and honestly, it is the hardest boss to defeat in this entire game.
Because the greatest threat to your financial freedom isn't the Federal Reserve, it isn't Wall Street, and it isn't a bear market.
The greatest threat is your own brain. We are crossing the bridge from the mechanics of money into behavioral finance and neuroscience. As the playbook states, investing is 80% psychology and 20% mechanics.
You can build the most mathematically perfect, low-cost, globally diversified portfolio on Earth. But if you lack the emotional control to stick to the plan during a crisis, all that math is absolutely worthless.
And we have to be clear here. When an investor panics, it is not a moral failing. It is not a sign of low intelligence. It is literal evolutionary biology working against them.
The human brain is a magnificent survival machine, but it was hardwired for an environment that existed 100,000 years ago on the savannah, not for the modern digital stock market. The primary glitch in our software is a cognitive bias known as loss aversion.
Let's talk about loss aversion and the saber-toothed tiger because this explains so much about human behavior. Behavioral economists have proven that the psychological pain of losing money is twice as intense as the joy of gaining that exact same amount of money.
Finding $100 feels good. Losing $100 ruins your entire week.
And neuroscience shows us exactly why this happens. When functional MRI scans are performed on people watching their investment portfolios drop in value, the brain processes that financial loss in the exact same neural pathways that process a mortal physical threat.
When you open your 401k app in the middle of a market crash and see that your balance is down $50,000, your amygdala, the primitive fear center of the brain, hijacks your nervous system. Your brain does not distinguish between a plunging stock market and a saber-toothed tiger jumping out of the bushes.
Your body enters a full fight, flight, or freeze response. Your heart rate elevates, cortisol floods your bloodstream, your pupils dilate. In that state of biological terror, your prefrontal cortex, the logical planning part of your brain, shuts down.
Your primal brain is screaming at you to do something to escape the pain. And in the modern world, escaping the pain means logging into your brokerage account and hitting the sell button.
Which relieves the immediate biological stress, but permanently destroys your financial future. You lock in your losses. But loss aversion is only half the problem, because when the market is booming, an entirely different, equally dangerous bias takes over. Overconfidence.
This is the ego taking the wheel. The book uses a great psychological mirror test. If you ask a room full of people, are you an above-average driver or are you an above-average lover? Statistically, 80% to 90% of the room will raise their hand.
Mathematically, it is impossible for 90% of people to be in the top 50%. We all suffer from the illusion that we are somehow fundamentally better, smarter, or luckier than everyone else. This is the Dunning-Kruger effect in action.
And when you apply that overconfidence to finance, it is a recipe for disaster. It leads intelligent, successful people, doctors, lawyers, engineers, to believe that they can sit at home on their laptops, day trade tech stocks, and successfully outsmart a global market comprised of millions of highly incentivized professionals and algorithmic supercomputers.
They confuse luck in a bull market with financial genius. They think, I bought a tech stock, it went up 40%, I must have a gift. No, you were just standing on an elevator that was going up anyway.
It's pure arrogance. You wouldn't walk onto an NBA court and assume you could outplay LeBron James just because you watched a basketball tutorial on YouTube. But people routinely assume they can outplay Wall Street because they read an article on Yahoo Finance.
Combine that overconfidence with negativity bias, and you have a toxic cocktail. Our brains are evolutionary Velcro for bad news and Teflon for good news. Recognizing a threat like a poisonous snake kept our ancestors alive much better than recognizing an opportunity like a pretty flower.
And the modern financial media complex has weaponized that negativity bias to monetize your attention. Bad news, fear, and panic generate clicks, viewership, and ad revenue. The market is functioning normally, and slowly compounding wealth over time does not make for a compelling television segment.
The coming economic apocalypse gets millions of views. If you are checking your portfolio every day and consuming financial news constantly, you are voluntarily subjecting yourself to psychological warfare.
Guy Speyer, who is a brilliant value investor, has a great rule for this. He calls checking the market daily brain candy. It triggers a dopamine loop that inevitably leads to anxiety and poor decision-making.
His advice is incredibly practical. Move away from the candy. Delete the brokerage app from your phone. Only check your balances once a quarter or even once a year.
But because we know willpower is finite, we cannot just rely on self-discipline to fight off millions of years of evolutionary wiring. We need structural guardrails. And this is where the true value of a financial advisor comes into play. But it must be a very specific type of advisor, a strictly fiduciary advisor.
We have to clarify this because the financial industry intentionally blurs the lines. What is the legal difference between a broker and a fiduciary?
It is the difference between a car salesman and a doctor. A broker, or someone operating under the suitability standard, is legally allowed to sell you financial products that pay them massive commissions, as long as the product is vaguely suitable for your situation.
Well, they are salespeople.
Right. A fiduciary, on the other hand, is legally mandated to act in your absolute best financial interest, regardless of their own compensation. If a low-cost Vanguard fund is better for you than a high-fee fund that pays a commission, the fiduciary must recommend the Vanguard fund, or they can be sued and lose their license.
They're legally bound to be on your side of the table. So having a fiduciary advisor isn't just about them picking better stocks. It's about having a behavioral co-pilot.
When the market drops 30% and your amygdala is screaming at you to sell everything and buy gold, Your fiduciary is the objective professional sitting in the passenger seat saying, take your hands off the yoke. We planned for this turbulence. We stress-tested this portfolio. We are not altering our 30-year flight plan because of a bad news cycle.
They save you from yourself. Which brings us to the ultimate philosophical core of this entire framework. We've given the listener the complete mechanical and psychological playbook.
Let's assume someone listening executes this flawlessly. They automate 20% of their income, they utilize low-cost index funds, they diversify aggressively, they implement the rule of 7, they ignore the media, and they let compound interest do its heavy lifting for 30 years.
Fast forward to the future. They have arrived, they have a massive net worth, they are multi-millionaires, they have achieved absolute financial freedom. What happens if they get to the top of that mountain, look around, and realize they are still completely miserable?
This is the great paradox of wealth.
Yeah.
We see it in the media constantly, billionaires who are paranoid, lonely, litigious, and deeply unhappy. There's this pervasive cultural myth that money will somehow fundamentally change our internal emotional state. It won't.
Money is simply an amplifier. It is a magnifying glass for who you already are. If you are an angry, insecure, and selfish person when you are broke, you are going to be a profoundly angry, insecure, and selfish millionaire. You will just have a larger blast radius. Success without fulfillment is the ultimate failure.
And Tony Robbins, who co-authored the text, makes a vital distinction here between the science of achievement and the art of fulfillment. The science of achievement is everything we've discussed for the last hour.
It is a replicable formula. If you follow the rules, keep fees low, diversify, compound plan, you will mathematically achieve wealth. Anyone can learn the science.
But the art of fulfillment cannot be plotted on a spreadsheet. There is no universally applicable algorithm for human happiness. What brings deep meaning, purpose, and joy to one person might feel completely hollow to someone else. You have to actively architect your own fulfillment.
And the fundamental premise is that you cannot wait until you hit a magical net worth number to start practicing fulfillment. You don't say, I will be happy when I have $2 million, because the goalpost will always move.
You have to make the conscious decision to live in what the authors call the beautiful state. And you have to make that decision today. A beautiful state means refusing to let external circumstances, a bad day at work, a drop in the stock market, an argument dictate your internal experience of life.
It is the active rejection of the suffering state. It's the realization that abundance is not a dollar amount. It is a mindset. And the most powerful tactical tool for breaking out of a mindset of scarcity and entering a state of abundance is the practice of gratitude and contribution.
The playbook talks extensively about Robbins' initiative with Feeding America, helping to provide 1 billion meals to families facing food insecurity. But the core lesson isn't about being a billionaire philanthropist. The lesson is about the psychological shift that occurs when you give.
Giving destroys the illusion of scarcity. When you are stressed about money, your perspective narrows. You become hyper-focused on what you lack.
But the moment you take a portion of your resources, even if it's just a small amount of money, or even just your time and expertise, and give it to someone whose needs are vastly greater than your own, you force your brain to acknowledge a profound truth. You have more than enough. You are wealthy enough to give. It rewires your nervous system from fear to gratitude.
And you have to build that muscle now. A lot of people think, I'll start giving to charity when I'm rich. No, you won't. If you won't give a dime out of $1 today, you are not going to magically give $100,000 out of $1 million later. The hoarding mentality will only intensify as the stakes get higher.
So the ultimate takeaway for the ambitious American listening to this is that building a fortress of wealth is entirely meaningless if you spend your entire life living as a prisoner inside it.
Financial freedom is supposed to buy you time, options, and peace of mind. It is not supposed to buy you a nicer cage of anxiety. The goal is not just to be wealthy on a balance sheet. It is to be wealthy in your daily experience of life.
Let's pull all of these threads together and synthesize the masterclass we've just gone through. We started by looking at a global economy that is inherently chaotic and unpredictable, and we established that the only rational response is to stop trying to predict the weather and start building a ship that can survive any storm.
We unpacked the violent mathematical power of compound interest, proving why you have to transition from a consumer to an owner by automating your investments.
We exposed the wealth-destroying mechanics of the financial industry, the hidden fees, the transaction costs, and the insidious pay-to-play kickbacks in corporate 401k plans. We showed how transitioning to low-cost index funds reclaims millions of dollars of your own capital.
We confronted the reality of market crashes, using the freedom facts to fundamentally reframe bear markets not as existential threats, but as the stock market going on sale. We explored the mechanics of the Rule of Seven, demonstrating how a cushion of yield-producing assets like MLPs and bonds can protect a retiree from ever having to sell stocks in a panic.
We outlined the Core 4 playbook used by elite investors. The obsession with protecting the downside, the hunt for asymmetric risk and reward, the critical importance of tax efficiency, and the necessity of multi-layered diversification across asset classes, geographies, and time.
And finally, we mapped out the battleground of our own biology. We explained how the amygdala treats financial loss like a mortal threat, how overconfidence leads to day trading disaster, and how negativity bias makes us susceptible to media fearmongering.
We solved that by establishing the need for systematic rules and fiduciary co-pilots, and we culminated with the ultimate truth, that the science of achievement must be paired with the art of fulfillment through gratitude and contribution.
It is a complete holistic operating system for navigating both the mechanics of modern finance and the psychology of human happiness, which leaves me with one final provocative thought for you to carry with you today.
Let's hear it.
We have spent an hour talking about the intense rigor required to plan your financial asset allocation. The top investors in the world obsess over diversifying their portfolios. They hold domestic stocks, international stocks, corporate bonds, real estate.
They build these incredibly robust financial structures so that if one sector of the economy collapses, their overall wealth survives.
Yeah.
They protect themselves against catastrophic, concentrated risk.
But ask yourself this. How often do you apply that exact same rigorous logic to diversifying your emotional portfolio?
That is a profound way to look at it. Emotional asset allocation.
Think about the mechanics of it. If 100% of your self-worth, your identity, and your daily joy is entirely tied up in a single asset like your net worth, the success of your startup, or your title at a corporation, you are taking a massive uncalculated risk.
You're completely undiversified. If the market crashes or your business fails or you get laid off, you don't just lose money. You lose your entire reason for existing.
It is the emotional equivalent of putting your life savings into a single, highly volatile tech stock on margin. Perhaps the ultimate bear market isn't a recession on Wall Street. Perhaps it's the terrifying moment you wake up at age 65 and realize you spent your entire life relentlessly chasing a number on a screen, and in the process, you let your relationships, your health, and your capacity for joy completely atrophy.
If that single pillar collapses, the entire structure of your life falls with it. You have to build multiple pillars.
Exactly. What if true, unshakable wealth isn't just about perfectly structuring a portfolio of index funds to survive the next global recession? What if it's about realizing that your core happiness, your fundamental well-being, was never tied to the fluctuations of the S&P 500 in the first place?
You need to diversify your identity. Invest deeply in your family, your community, your physical health, your hobbies, your spiritual life. What if you are the diversified asset?
When you achieve that level of emotional diversification, you win the game before the market even opens. It changes everything.
It really does.
Remember how we started this deep dive? We talked about looking for that clean white line on a medical x-ray, the desire for certainty in a chaotic world. The reality is, the global financial markets will never give you that certainty. They will always be murky, volatile, and driven by forces outside of your control.
But you don't need the markets to be predictable. If your own internal foundation is rock solid, you can be unshakable in the muddiest of waters.
Thank you so much for joining us on this deep dive today. We hope this playbook arms you with the exact tools you need to take immediate control of your financial destiny, audit those fees, automate your wealth, and most importantly, consciously choose to live in abundance starting today. Until next time, keep learning, keep building, and keep diving deep.